Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. It's generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right in, take a look, and see what people are sharing, and I'll share my opinions as we go through it. If you want to follow me, it's at Finance, and if you want to join our community, finding-value.com, where I dive deeper into all these topics and subjects looking for potential investment opportunities, sharing those opportunities with everyone that's in the community. And I also go over a lot of trainings, technical analysis trainings, fundamental analysis, looking at companies, presentations every once in a while, and answering your guys' questions. So starting with QE Infinity, why is the 10-year bond yield in free fall? Bad jobs number coming? I thought tariffs were inflationary. I'm going to go with Federal Reserve for $200, please. I think the Federal Reserve, or someone that is linked with the Federal Reserve, is buying them. And they're lowering interest rates to keep the stock markets up and keep the yields underneath 5%. That's my guess. Peter Schiff says, I've always known that the U.S. government was a criminal enterprise. My father called it the federal mafia, but it took a second Trump term and the help of Elon Musk to expose the evidence to prove it. So far, they've only scratched the surface. We need a special prosecutor. Yeah, there's probably a whole bunch of stuff going on that's very, very rotten behind the government. Yeah, I would agree. Ian Castle says, patience in investing doesn't mean you make slow decisions. Active patience means knowing what you're looking for and doing nothing until you find it. When you do find it, you can act in an instant. And that is one or two of the most important things that when people went back and studied Warren Buffett and Charlie Munger, they said, you know what, why you guys made so much money is because you practice extreme patience. And then when an opportunity comes, you don't think twice, you pounce on it. So that's coming from someone studying the greats. Another thing that they're very good at doing is being able to hold on forever. So they have the companies that they like. They have extreme patience. They wait for an opportunity to buy something that's incredibly cheap in relationship to the fair value. And then they buy it with humongous asymmetry in that stock, and then they hold it forever. That is what gets them these large returns. It's nothing else. Their ability to pick stocks is not as good as you think. They've got maybe 12 really good stock picks of their life with the gigantic asymmetry out of a good 400 that they have purchased. So it's not a huge success rate. So the asymmetry and their ability to buy those and properly position size them is what gave them the advantage, or the returns, I should say. HFI research says, so those fake Reuters OPEC plus news came from this. We did see a whole bunch of fake news coming out on oil before the elections, like right when they had the elections and right before the elections. And look what came out. It says, can someone explain to me why the Department of Defense provided 9,147,000 to Reuters for active social engineering defense, large-scale social deception? There was a whole bunch of fake news from Reuters about OPEC coming out and stating that they're going to flood the market, and that I think it helped push oil prices to where we are today even. So I think there's a bunch of this going on here, guys, where you're getting this social engineering, large-scale social deception. And this is why it is so important to form your own opinions and not go through the news. I see a lot of people, they're asking me all these questions like, oh, what do you think of this? What do you think of that? It's like, guys, the charts don't tell me that. You have to go with how people are positioning. They release this type of stuff out, and then they take positions against you. They get you to sell your shares for cheap so they can steal them from you. And they're using social engineering defense, ASED, or large scale social deception. Be aware of this. Don't fall for it, in my opinion. IHEAT says world's not ready for steepening of oil decline curve from underinvestment upstream for over 10 years. The majority of oil fields worldwide are now in tertiary recovery mode. So the world isn't ready for it. They think that we can just increase production and that the price of oil going up means that we'll get more oil. I'm not 100% sure of that. What happens in every oil field is it goes up, you hit a peak, and then it goes down. No matter how much you drill, it is based off geology. And when you add up all of these fields, it will create a large normal distribution curve of production. And it depends where we're at in that normal distribution curve. Um, we knew where oil was before the 2010s in terms of shale. Like we knew it was there. We just didn't know how to get everything out of the shale. And now we're starting to hit peak shale perhaps, or pretty close to it. And that's where the majority of growth came from in the world. It added approximately 2 Saudi Arabias of production to world oil production, which is big. If that rolls over, I don't think people are ready for that. This world looks completely different. That's where I think gold and silver will do incredibly well because oil declines will push oil prices up. It will also push interest rates up, and interest rates going up, you're going to see money rotate out of bonds, which it's already doing, and you'll see money rotate out of stocks. Stocks being the technology and S&P 500. Oil will be a great place to invest, and same with precious metals. And I even think precious metals could beat the oil move, and maybe even the oil equities. Correlation Economics says nobody likes gold miners. And I was just talking about gold miners. Look how low we are here, guys. This is implied allocation gold miners. So ETF market share of gold miner ETFs versus equity ETF assets. Super low. Super, super low. Unusual way. 2024, the median age of the first-time homebuyer climbed to age 38, an all-time high per CNBC. In 1981, the was aged 29, according to NAR. When you look at the demographics, if you guys are looking at demographics to see when the first-time homebuyers are, you have to look at 38 and slightly behind it, not 29 or 30 anymore. So 38, we have a huge amount of family formations at that age that are looking for homes. It is way higher than, I think it's probably one of the highest times in history in America. There was a big surge in the 1940s after the World Wars and having kids and all that stuff and all the men coming back. And there was another big surge of all of the babies that those guys had, which was in the 1970s. And now it's the babies of the babies, which is the millennials. Google priced in gold, upward momentum slowing to a grinding halt. The capital rotation process gets much more evidence once this chart closes below the dashed line. Not many understand this. Google priced in gold. And we're starting to see gold start to challenge the big dogs here, Google being one of the big dogs. As gold continues to go up and as the technology stocks start to roll over, we'll start to see more and more of these break out. And what that means is that capital is going to rotate into the stuff that we're in, commodities, precious metals, and away from technology stocks and the S&P 500 stocks. This has happened many times in history. It happened in the 1930s. It happened in late 60s, early 70s. It happened in 99, 2000, 2001. And then it's happening right in front of us right now. So the biggest amount of money that you can make in the markets is to nail these bottoms in these capital rotation events. And you can go in either direction. So if you had purchased in 99, 2000, a bunch of commodity type companies and held it through the next 10 years into 2008 or 2011, depending on how good you are at picking tops, you would have made many, many, many fold increases, 10x, 11x, 14x, something like that from bottom to top. Could even be more depending on the companies that you selected. There were companies individual companies that went up 1,000x in that 10-year period. In 2009 to 2010, 2011, what bottomed then was technology. Even you could have went into home stocks too at that time, home builders and stuff, but um, home builders would have been a great addition there, and same with technology. And knowing that rotation in this location down here, where you want to buy, technology stocks. This is the whole bottom. It's a shoulder, head, shoulder bottoming pattern, and you could buy them all through here at the bottom of that time frame. And Google would have been a great buy down here, and then even on the breakout too, and then just held it all the way up and sold it up here of where we are today. So that's the cycle. You're just seeing it from Google's perspective. Now gold and commodities are going to outperform, and it's going to come back down. Um, and that's the cycle going back and forth. Bullish trend, oil down, but stocks are flat. Usually stocks bottom first, and that's what we're seeing. Oil down and stocks are flat. Per NOV customers are preparing for offshore upturn in 2026. And that's all the offshore crew. And I listen to all the conference calls of a lot of these companies, and they're all saying the same thing, just what she mentioned here. At least, well, NOV, which is National Oil Well Varco, I think. That's what basically the popular opinion is of the insiders. Giovanni, however you pronounce his last name, charts on U.S. petroleum inventories in million barrels. We're super low on crude and SPR. Crude and SPR is way down there. Distillate's pretty low. Gasoline is kind of average, and then we are super low on all of that combined. Now, Warren Buffett says, if you're comfortable with your inner scorecard, I think you're going to have a pretty happy life. The people who strive too much for the outer scorecard sometimes find that it's a little hollow when they get all through it. What that means is that it's better to have validation from yourself and say, you know what, I'm pretty content with myself, versus trying to find happiness by impressing others and the scorecard of others. The 0% line is crossed, so we're back above, going into positive territory. So this is U.S. Commodity Price Index, the 10-year rolling compounded annual growth rate for 1815 to 2024. We have these cycles where it cycles down, cycles up, cycles down, cycles up, and we just cycle back and forth. And now what he thinks is that we're going to have a big cycle up into maybe 2045 is the estimate for the commodity price index based off of this cycle here. Garrett Goggins says the gold is gone, people. So gold material is out of stock. This is the Shuibai market with 0.12 million gold stores and 8,000 gold companies. It is the world's largest gold product distribution center. Since December 20th, 2024, there has been a shortage of gold material supply. The situation has become even more severe now. Short gold, guys. This is going to be our big bull market. It's time to go. You're neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. Benjamin Graham. So don't listen to the news, guys. You're not right or wrong. It doesn't matter who agrees or disagrees with you. You are right because your data and reasoning behind that data are right. Someone asked me for the update, why not share? So this is the global M2 money supply, or the credit cycle, which drives oil prices. And I've said this before. Credit coming into the system puts oil into a shortage, and then oil responds to that shortage. And this is the credit cycle and oil price. The global M2 money supply is the dark line. The green line is oil prices. And you can see how oil prices follow. And we have been coming higher here with the global M2 money supply here recently. So we should see an uptick in oil prices, most likely. The Crude Chronicles, another one from him. He says, new post, energy, not tech, is worthy of your cost of capital. The gist here is returns on capital, ROC, in excess of the cost of capital show that the tech sector is overvalued and energy is undervalued. It also implies that the S&P 500 could drop to 4,700 should this persist. Big oil rewards returns on capital with shareholder-friendly incentives, while big tech lacks such alignment, with many incentives unrelated to financial performance. Return on capital is now relevant for big tech as the industry has grown more capital intensive. Shareholders dislike capex on lower return projects that diminish overall shareholder returns, like ZOM and Microsoft. Oil and gas market cap as a percent of GDP points to real returns of 9 to 10% per annum for the next decade, beating the S&P 500 in my view. What's up, everyone? Rob here with the Crude Chronicles. Happy New Year. I got an awesome piece today. Let's jump in. And that's what he's talking about above. So tech is overvalued, energy is undervalued. So information tech is way up here. This is your enterprise value to invested capital. Fundamentally overvalued healthcare, consumer discretionary, real estate is kind of more fairly valued, and financials. Energy is the most fundamentally undervalued of all of them, given its enterprise value to invested capital. And that is what we are looking at here. Another one from crude, all commodities versus the world M2 expressed in USD. And you can see the cycle here. Commodities are a function of the M2 money supply or credit. And I've said that before all these times, and that's why I watch the real estate cycle, which drives credit. It's the biggest driver of credit. Here, he overlays the world M2 expressed in USD and your all commodity price. So commodities are a function of credit being created. I know that's weird, and a lot of people don't understand that. Well, supply and demand. Guys, the supply is your commodities. The demand is the credit creation. And if credit gets created faster than the commodities, well, that's your disconnect. That's where the demand is put into a shortage of commodities. Commodities are put into a shortage based off the credit creation. Ed Finley Richards, he says historical tanker discount to NAV, so that's net asset value. So your median price divided by net asset value, it's low when it's at 50%, and we are real close to 50 to 60% down here. It is undervalued, tanker discount. We're out here buying loonies and toonies. This is the Canadian dollar bouncing off support, and I agree, this is a really good area for additions to Canadian assets. This is the opposite of flight of safety. We've got a topping pattern in the U.S. dollar index futures, which is topping and potentially going down. This is the bottoming of the Canadian U.S. dollar. So the dollar is driving some of this movements in other currencies. This here will drive money into Canada and their stock market. It's going to drive money away from the US dollar based assets into Canadian dollar based assets. And this is all currency related. All of these currencies are also tied to this world M2 expressed in USD. They're all interconnected here, guys. This is gold. So gold is close to breakout versus the S&P 500. This is where a bigger rotation comes in to favor gold. The big 0.5 is just above us. We're ready. We're trying to break out here, where gold starts to outperform the S&P 500. These big capital rotation events, you'll start to see these currencies like Canadian dollar, Australian dollar, they'll all start to outperform. When you buy at these bottoms here, guys, this is like the best opportunity that you can possibly have during this time frame. There's no other opportunity here that's this good. And it only comes once every 10 years. You can now buy over 40 barrels of oil with just 1 ounce of gold. Apart from being the brief aberration during COVID, oil has never been this cheap. Record low oil prices have kept a lid on U.S. consumer price index. Even if we drill, baby, drill, both oil prices and the consumer price index are headed much higher. Yeah, totally agree. Freight futures AM update. We've got dry bulk up 3%, Panamax up 1%, and then tankers are flat today. Canadian venture CDNX stocks are starting to break out versus the price of gold after 4 years. A very bullish implications for so many undervalued hidden gems, especially with inflation cooking and tariffs galore. Gold, silver, copper, lithium, battery metals, platinum, crypto, AI, healthcare, and much more. So this is Canadian composite index starting to break against gold. Guess what else is linked to this? This chart right here. It's gonna when this moves up, it's gonna push money. Money's gonna rotate into Canadian stuff. Keep that in mind. And see this bottom here in 2020? The bottom here, 2020 is right there. See that bottom in 2020 and then the move higher? That move higher is this bounce off the bottom there. And that went from $2-ish all the way to 688. So you can buy it again at 243 and get I think this is going to be a big bottom where we get a big move higher. So if you guys want to know like my top companies and what's down here, I don't have Canadian specific. I have some Canadian companies that are mainly oil and energy service. These things are going to rip. It's going to rip. So look at these. We can start digging through the Canadian Venture Composite Index. I can see the best opportunities, and I'll share it with you guys. Coming on up. Here's Gary. I'm going to read this one to everyone. It says we are now at that point where the nervous Nellies and the perpetual trolls can no longer deny that we were flat out wrong, and they missed the buy signal again. I think he's talking about gold here. They are no longer in denial. Now they're worried that the market is overbought, so they will continue to stay on the sidelines, afraid to buy into an overbought market. Hint, markets that are in the advancing phase of a new intermediate cycle embed in the overbought condition. Prices behave differently in the advancing phases of intermediate cycles than they do in declining phases. At some point, FOMO will become too intense to resist, and these people will finally throw up their hands and click the mouse. There will be many traders like this, and they will all panic buy at the same time. That means you run out of short-term buyers. That's when we will get our first significant pullback, something that lasts 5 to 8 days, that will knock the late FOMO buyers out for a loss. They will then become even more cautious before pulling the trigger next time. Ironically, that just guarantees they make the same mistake and buy at the next short-term top and get stopped out again during the next correction. This will continue until all these traders become super overconfident that the market will never go down. They will buy into the hype and that the fundamentals have changed. They will buy into the intermediate top and get caught in a 5 or 10 week intermediate correction, and the process will start all over again. This is how you lose money on the long side in a bull market. You know how I don't lose money in a bull market? I just stay long. it's that easy. I bought in 2020 and I've been buying ever since because we see all these great opportunities for much higher prices in commodities and precious metals. Warren Buffett says, what the wise man does in the beginning, the fool does in the end. So the wise man in the beginning buys it when things are low, and the fool buys it at the end and buys the tops and loses money. That's what it means. Charlie Munger says, someone will always be richer faster than you. This is not a tragedy. I agree. Do your own game, guys. I don't play the Bitcoin game and the crypto game. I think there's a ton of risk over there. I even think that they could crash and go to zero. Yeah, I said that. What would cause that? A capital rotation event when money rotates away from rotates towards commodities, away from tech, and that will come. And then we'll see how stable crypto is in that type of condition. We don't know. If U.S. shale production has kept the same gas to oil ratio, U.S. oil production would be around 14.7 million barrels a day today. Instead, it's only about 13 million barrels, as gas makes a larger portion of the gas-oil mixture. This is warning at 0.5 monthly closing basis. The event is confirmed for gold divided by SPX capital rotation event confirmation dial. Nice. That's when you break that horizontal resistance line. Christine says, newer wells in the Permian's Delaware Basin are underperforming earlier vintages by 10 to 20% per foot. So they are becoming less efficient at or less productive per foot on these newer wells. We are seeing less, they're not as efficient as we go into lower tier production. Josh Young, the U.S. available and active rig counts have collapsed. So we are collapsing the rigs at the same time that we are getting less per foot drilling results. We are drilling a lot longer laterals, though. Horizontals, laterals, yeah. Christine says, the author believes rig count needs to double just to keep the Permian flat over the next 5 years. So drill, baby, drill just to maintain what we currently produce is what's going to happen. Yep. and we're going to make a lot of money in the drilling companies. Correct. The Russell 2000 is issuing an early warning by breaking down versus gold. The rush for the exits can arrive at any time, and we've got an early breakdown where gold's starting to outperform the Russell, and this is probably the beginning. We could also get a retest move on this, but yeah, we're seeing the capital rotation all right in front of our eyes happen. And that's what we've got for today, guys. So give me a thumb up for the content, subscribe to the channel, subscribe to the website. Special is the coupon code if you want a special discount. And we've got a Sunday question and answer session coming up at 5 p.m. Mountain Time. All right, guys, we'll catch you next time. This is Finding Value.